So this lecture is going to cover the first section of chapter 12, which is about gross domestic product. You might have heard of GDP, and it's basically a measure of our economy in one shape and form, but it also comes with its limitations. So we'll learn how to calculate GDP. We'll also learn the difference between nominal and real GDP. Again, what are some limitations to what GDP can measure in terms of our economy? And how else can we measure the economic health in terms of income and how much is being produced? Okay, so economists normally monitor our macroeconomy, the economy as a whole, using something called national income accounting. This is a system that collects statistics on how much is produced, our income, investment, and savings. So basically all forms of economic activity. GDP refers to the entire value of all final goods and services that are made in a country's borders in a given year. So it's basically the amount of money spent on producing these goods and services. However, it doesn't include the value of intermediate goods, basically the goods that were used, such as physical capital, to create those goods and services in the first place. So, for example, if we take a car, right, if we are looking at the final sell or the final production of all cars, we would only be looking at the costs of those cars and not the actual cost of those products that were used to make that good, if that makes sense. So there's actually two ways to calculating GDP. One is called the expenditure approach and one is called the income approach. The expenditure approach totals annual expenditures on 4 categories of final goods or services. The first one is consumer goods and services. The second one is business goods and services, so maybe like, how much money a business pays for, certain things that they are reselling. Government goods and services, so things that the government uses themselves. And also net exports or imports of goods or services, so things that are made by people affiliated in the United States that work somewhere else and then import those goods. The income approach calculates GDP by adding up all of the incomes in the economy. And the understanding of this is if you take the income approach instead of the expenditure approach, what you're getting is about the same amount because the income that people are paid is the same money that would have been spent on the goods and services that were provided by those workers in the workforce. So hopefully that makes sense. But yeah, consumer goods also include all durable goods, which are goods that last for a relatively long time, such as microwave ovens, refrigerators, washing machines, but it also includes non-durable goods, things that don't last very long like food, light bulbs, batteries. So nominal GDP is a type of GDP measured in the current prices. So it doesn't account for price level increases from year to year. So for example, you might calculate the nominal GDP of a car in 2020 based on the price of that same car in 2019. And then real GDP is GDP expressed in constant or unchanging dollars. So let's start here. In year 1, let's say that the economy's entire output is cars and trucks. So this year, the economy produces 10 cars at $15,000 each for a total of $150K, and 10 trucks at $20K each for a total of $200K. So you get the total $350K. Since we are using the current year's prices to express the current year's output of productions, then we get a GDP of $350,000. Now in year 2, let's say the economy's output doesn't increase, so they have the same exact amount of cars and trucks. However, the prices have increased from $10,000 for cars and $10,000 for trucks. So now you see $370,000. So this can be very misleading. It looks like the economic health is increasing. However, it's simply the fact, or in other words, there's an increase of spending, like more of these goods are being purchased, but it's actually just yes, profit is increasing, but it doesn't necessarily mean that that there's more cars and trucks being produced and sold. So instead, he would take real GDP. So to correct for this misleading information, they'll establish a set of constant prices by choosing one of the years as the base year. So for this example, they're using year 1 as the base year. And so instead, the real GDP for year 2 would have actually been $350,000. So here are some of the limitations to GDP. It doesn't actually take into account a lot of things. For example, GDP doesn't measure non-market activities. So if you babysit, if you mow someone's lawn or do errands for someone, if you make someone food, you're not being paid to do those things. And so that activity, despite it still being technically an economic form of activity, doesn't go into GDP. Negative externalities. So we talked about externalities before, which are side effects of basically side effects in the economy that affect outsiders that are not necessarily consumers of those goods and services. So pollution is a really good example of this. Underground economies such as the black market, those are under the table wages. A lot of people also who pay rent under the table, like if they're living in a shared household among roommates who aren't necessarily their family members. This happens a lot, for example, in college towns, and so that's kind of like stuff that can go under the radar of economic activity. Quality of life as well. So, a country like India that has a really high GDP is actually a developed country that has a high poverty rate. The majority of their citizens are below the poverty line, but they have a high GDP because, again, it accounts for all the final goods and services, and they have a very large population. I think they're still one of the highest populations for a nation in the world, so that makes sense. Okay, and then we've got other income and output measures aside from GDP. So gross national product, that's a measure of the market value of all goods and services produced by Americans in 1 year. National product, or net national product, is a measure of the output by Americans in 1 year, but also subtracting adjustments for depreciation, which is the loss of value of capital equipment that results from normal wear and tear. So normally, for example, if a factory replaces old, machinery with newer ones to make up for that loss. And then national income is equivalent to the net national product sales and excise taxes, which, if you remember back in the earlier chapters, excise taxes are taxes that are on goods that are kind of meant to be discouraged from buying, that are not seen as necessities, such as cigarettes and alcohol. Personal income, or PI, which is the pre-tax income paid to U.S. households. And lastly, our disposable personal income, money that is readily available to be used. Someone with higher purchasing power, for example, would have higher disposable personal income, and this is your personal income minus individual income taxes. So this is just a visual of everything that was mentioned, and then we'll get into the factors that influence GDP next time.